Hello guys, and welcome to another deep video. Today taking an in-depth look at Dell Technologies and Autodesk Incorporated. Both companies reported earnings yesterday, and now we're covering both of them because they both dropped significantly since the earnings reports, and now we've got to analyze them and see if they are a buy or if you should stay away from them. First, we'll start with Dell Technologies, an American technology company that develops, sells, repairs, and supports personal computers, uh, servers, data, storage devices, networks, switches, software, computer peripherals, including printers and webcam, among other products and services. First, let's start with their business metrics. Their return on invested capital is 10.5%, which is okay. Current ratio is 0.74, which is tolerable, I would say. And their return on tangible assets is 5.7%. Their free cash flow yield is 9.7%, but there is a huge caveat here. This is their free cash flow from 2024, the fiscal year of 2024. But if we take 2025, well, the next fiscal year and basically the trailing 12 months, their free cash flow yield is closer to 4%. So this is this is sort of a big, big sign that the business is not stable. I know I've said big like 5 times, but this is important. Your free cash flow should never just drop. So their free cash flow as of the last 12 months is 1.65 billion. And so to go from 5.9 to 1.6 something billion is a huge drop. Their price to earnings is 16 and their current price is $101. Let's start with Graham's valuation. Based on Graham's valuation, they're hugely undervalued, but now let's do the discounted cash flow model. And the discounted cash flow model will use, so we've seen that their free cash flow hasn't really grown that much. And we know that 2025 will be a bad year, will with free cash flows being very close to the 2015 levels. So basically, they have had almost no growth. So I'll just drop the free cash flow growth to somewhere around 3.5% because I think that's what they deserve. And this gives us a DCF price per share, which is slightly higher than current price. Uh, Historical multiples, we see that they've been unprofitable for quite a while. But now let's go to the multiples valuation. Their multiples valuation, I've compared them to HPQ, so HP Incorporated, Hewlett Packard. You must have heard of it. It's a very known company. I'm not sure if I don't think you've not heard of it. It's very popular, especially in office products. Next, the dividend income model. I'm not sure this is warranted because their dividend has only been out for a few years, and to add to that, their free cash flow being unstable, I don't think they'll increase it. So I just think we should ignore it. So I'll just remove this, but I'll add the multiples valuation since I think HPQ is a good comparison. And we get $141 as intrinsic value. But what is of note here is that their valuation is hugely increased by Graham's valuation. Graham's valuation is useful in general for companies that actually grow. Now, technically speaking, Graham doesn't really care that much about growth. He only cares about value. But from what I've found in most use cases, it is actually the companies that actually grow their earnings a lot that really, let's say, force this valuation, um, deserve this valuation. Sorry, I don't think Dell deserves $220, but that's the formula. That is what we got. So we'll just leave it there. Using the averages, we get an intrinsic value of 131 and the acceptable buy price of 111, of course, applying a 15% margin of safety. Now, what I believe is that because of their fluctuating free cash flow, because of their lack of proper management when it comes to future and past growth promises and delivery on these promises, I believe that they deserve a margin of safety closer to 30 or 35%. Because yeah, you just can't trust such a company. This is not the type of company you just apply 15% margin of safety. This is not that type of case. So I think a 30% margin of safety, maybe even 45% margin of safety is warranted here. So their acceptable buy price is closer to 90 and $90, 85 to 90 to $93. Now next, go to Autodesk. Uh, Autodesk is not as well known as Dell. Autodesk is an American multinational software corporation that provides software products and services for the architecture, engineering, construction, manufacturing, media, education, and entertainment industries. They do not pay out the dividends, so compared to Dell, they're completely different from a value investor's point of view because dividend paying companies are valued differently. You care much more about free cash flow. You always care about free cash flow, but in non-dividend paying stocks, you care a bit less because if their free cash flow varies a lot, there is no problem when it comes to cutting their dividend. They're trading at 2.3% free cash flow yield and a 53 price to earnings. So completely um, different story compared to Dell. They're way overvalued, above market averages. Now let's look at the business metrics. So they have a 16% return on invested capital, a 40% return on equity, a 15.5% return on tangible assets. That's really good, and a current ratio of 0.82, which is okay, I would say. Now let's do grants variation. Let me find 1 second. Let me find their 9.51. Their This is their 2025, the fiscal year 2025, 2026 ending. Earnings per share of 9.51, and we get an intrinsic value of $223. The discounted free cash flow, we can see that they've grown here from 632 million to 1.3 billion. They've slowly grown over this period. The average growth rate is mistaken here because of 2019, 2018 and not 2019 because it went from a negative to a positive. But as we can see here, a doubling over 9 years, it's about 7 to 8% growth rate. Actually, no, 8 to 9% growth rate. I'll just put it at 5.5 or 6%. I think 6% is not impossible in my opinion. Um, Although I'm not really sure of this business model, so this is why you do your due diligence. I'm not really the biggest, let's say, fan of Autodesk. I don't like their growth. I mean, would you really pay 60 times earnings for a company that has only doubled their free cash flow in 9 years? I mean, sure you can, but are you willing to? I mean, even if they have a 10% growth rate, they're still way overvalued. And a 15% growth rate, they're overvalued. And a 17% growth rate, so they're priced in for a 17% growth rate at a 2% perpetual, and they are definitely overvalued. I'll just put it back to 6%. Their historical multiples, well, they've been negative for many years, so their average P is dragged down by those negative years. I will not compare them to other companies, and the dividend income model is not doesn't apply here. So removing multiples, we get dividend grams variation and discounted cash flow. Doing the average is $174 and applying a 15% margin of safety because they have better financial ratios and they have actually proven track record of free cash flow growth, and they do not have the problem with dividends. I apply a 15% margin of safety, thus giving us a $140 acceptable buy price. So yeah, this is overvalued, very overvalued. Dell is not a buy, and I don't think this is either. Of course, Dell is much closer to a buy than this is. If you do not have any need for margins of safety. If you did your own due diligence, then Dell might be a buy, but Autodesk definitely isn't. I do not see the potential here. It's a low growth company, to be honest, for that kind of premium you're paying. If they grew like Google and they have, so if they were like Google, Google is a great opportunity these days, guys. I mean, if they do not, the biggest risk factor in Google, to be honest, is their antitrust case. And with the monopolistic tendencies of the Republicans and Trump, I do not think that this case will have any future. I mean, believe what you will about Trump or Republicans, but objectively speaking, from the perspective of Google and their shareholders, I don't think there is a problem here. And Google, I do not own Google stock. I owned Google stock at some point in the past, but and I made some money from it. Uh, but yeah, I think their opportunity today. I would invest in them, but sadly, I do not have the capital at this second. Dell is not comparable. Dell is a much worse company. Google has a pristine balance sheet. Uh, Dell has a horrible balance sheet compared to Google. Autodesk is better from a financial perspective, but much worse from a valuation perspective. And to be honest, valuation and quality are two different types of investing. Warren Buffett is more of a quality value investor. I am more of a value quality investor. Uh, so the thing is, he first looks for quality, then he looks for value. I look for value, then I look for quality. It's a different perspective. You can use whatever perspective you want. Autodesk is definitely neither quality nor value. Dell is nearing to be a value play, but definitely not a quality play. So this is not. Dell will never be a long-term hold. It's merely just to get some short-term returns from their valuation mispricing in the market. Now, let's talk a bit about our affiliate for today, Ticker Data. Ticker Data is a tool I used. So you see this template here, you see these formulas, you see these real-time calculations, you see this real-time financial data. So this is Ticker Data. You can check it out in the link in the description below. It's a great tool. I use it all the time. As you can see, I even use it for my videos. It's cheap and it also has a lot of templates. They have great support, and I think you just love it. Also, do not forget to check out my investing blog from the link in the description below. My blog features in-depth analysis on a diverse range of stocks, and now I'm planning an article talking about the current market variations and so on and so forth. And yeah, I think it is just great. I think you'll love it. So this has been it for today. I hope to see you in the next video. Bye.